Imagine yourself on vacation on a cruise ship. You have internet access and you're still continuing to make money while you're sitting back lounging, probably sipping on an alcoholic drink and a pineapple base, living the life. You can still make money trading options or investing while you're on the go, on vacation, away from home, in the car on the way to work, whatever the case may be. Technology has allowed us to trade and make money regardless of wherever we are in the world. And what's a great way to make some additional money on the side that doesn't require you to check in or swipe in anywhere, to work for someone else, to answer to someone else? Options trading. Now, most people think that trading options is complicated, but today I'm going to make it super simple for you. We're going to master the basics. You're going to build your foundation with proven fundamental investing principles that successful traders like myself use every day. And before we start, I want to invite you to join our Patreon community, All In Society. It is free to join, but if you want to learn how to become a fundamental investor, to be able to open up individual companies and be able to interpret the data, looking at balance sheets, looking at the profit margins, the PE ratios, all of those things. If you want to understand that and be able to open up a company and look at it fundamentally and invest with confidence for only $10 a month, you can join our Patreon and check out the fundamental investing playbook that we have in there available to you now. With fundamental investing, I've been able to pull money out of my previous employers' retirement accounts and manage it myself, in creating returns that are almost laughable compared to what I was getting when I held my retirement funds in those accounts that are managed by some stranger that I did not even know. They didn't know my needs, wants, outside of a few questions on the retirement page when you set it up. But I, with the fundamental playbook and those skills and that information, have been able to double, triple my retirement accounts in a very short amount of time. Now, the turning point for me was back when I was working in the casino industry, which was not too long ago, about 2.5 years ago. And I was listening to a lot of the employees talk about trading options. Now, mind you, this was in a casino where I worked in the poker room. I love playing poker. I still play poker to this day. But a lot of our employees had gambling issues, and they were degenerate gamblers. And so to hear them and the amount of money they were making in a short amount of time, I just thought trading options was just another form of gambling. And so I never really got into it. It wasn't until I attended a conference in Washington, D.C. called the Black Wealth Conference. There was a speaker there from a bank and explained options and broke it down in a way that really blew my mind. And I will explain and I will provide that example for you. It made it so much easier to understand. And once it clicked, once I understand, you can use options to generate profits, to hedge your bets, and to place bets with smaller amount of money to make large returns. I was hooked. So if that sounds advantageous for you, if that sounds like something you're interested in, let's start your journey today. From a complete beginner to confident trader in no time. We'll guide you through each step of the process. All right, so let's get down into it. Stocks versus options, or how I like to think of it, owning versus renting. So stocks are traditional ownership. You purchase a stock in a company, say Apple. You are purchasing shares of ownership in a company. Yes, you own that company. Tim Cook works for you. Tim Cook is the CEO of Apple. They are obligated to create returns for their shareholders, and you are an owner, you are a shareholder of that business once you buy shares of that company. Now, purchasing shares of a company potentially gives you voting rights on company matters. The more shares you have, the more power or sway that you have in that company. Now, you can hold these shares indefinitely with no expiration, okay? You can hold it long term. One of the greatest investors of our time, Warren Buffett, he held his investments long term and let them just pile on top of each other, compound investing until he just became this behemoth, the best investor ever, in my opinion. And I would like to say rest in peace to Charlie Munger, who was his partner but passed away. Now, you make money in buying shares of a company when the share price rises. That's how you profit. Okay? Now let's take it to options. Options are kind of like renting. They are strategic contracts. And now I'm going to stop you there. Before we dive in, I want you to think of an option contract as if you are purchasing a coupon. And by purchasing that coupon, we're going to call that the premium, the amount of money that you use to purchase that coupon. Once you purchase that coupon, you have the right, but not the obligation to buy or sell an asset in terms of an option contract. Okay? So again, I have a coupon to buy, let's say, iPhones, a new iPhone 17. I have a really cool coupon. I'm going to sell that coupon for someone, and they're going to pay me X amount, and that is the premium, okay? And by purchasing that coupon, the purchaser, the buyer, now has the right, but not the obligation to buy or sell that asset in terms of option contracts. Now, you have a limited amount of time that you can use that contract before it expires. This is a major difference between holding shares of a company. Remember, holding shares, you can hold it indefinitely with no expiration. But while option contracts, when you purchase that contract, you are purchasing it for a limited time with an expiration date. That coupon comes with an expiration date. Now, the cool thing about options is you can profit when the share price goes up or goes down. Remember when I was talking about hedging your bets? And so for those of you who are sports bettors, you probably really understand that and appreciate that. Okay? All right, let's go a little bit further. So you might still have some questions on why would you choose to purchase an option at all? Well, leverage. You can control large portions with smaller investments. So you can access expensive stocks like Netflix and Meta through affordable ETFs like QQQ. And you can buy a call option on QQQ. And so let's look at that real quick, so you get an example and understanding. So if you wanted to buy shares of Meta, right? Meta right now costs $743.75. Or you could purchase an ETF. Now, let's break that down. And you can break this down and get this information in the Fundamental Investing Playbook. But I'm going to give you this information right now so you can understand. So if you're not familiar, We have indexes. I want you to think of an index as a scoreboard. Okay? Indexes, you might have heard of the S&P 500, the NASDAQ, the Dow, the Russell. Those are indexes, or what we're going to call scoreboards. Now, those scoreboards track specific assets or industries or sectors within the entire stock market. The S&P 500 is typically your 500 largest and arguably the best companies on the stock market that you can invest in. The S&P 500 tracks those companies and provides a scoreboard for those companies. And then the NASDAQ, the Dow, and the Russell track other specific industries and sectors in the stock market as well. Okay? Now, remember we talked about QQQ, all right? That was an ETF. ETFs mirror or track the scoreboards or indexes. The ETFs are tradable. So much like you can buy Meta shares or Apple shares, you can buy shares of QQQ, the ETF, the exchange traded fund that mirrors or tracks the NASDAQ. Okay? So again, the indexes are our scoreboards that track a combination of companies that are traded in the stock market. For NASDAQ specifically, they have a higher concentration of tech companies. Okay? So instead of investing in Meta, which was 700 plus a share, I decided to invest in the QQQ, which has a pool of stocks, including Meta, in here. Okay? As you can see here, and this is on Yahoo Finance. And we'll talk about this tool because this is a tool that I use every single day. And I want you to use this every single day as well. Okay? So QQQ, you can scroll down. It says fund composition. It says holdings. You can see exactly what is in this ETF of QQQ. And you see right here, Meta is just under 4% of this entire fund. And this fund costs $595 if you round up, $596. Okay? So instead of investing in the asset of Meta itself, we invested in QQQ, which Meta was a part of, on top of other great companies in part of, which is also cheaper than getting into Meta itself. Okay? So that's just an example of leveraging, and we have a lot more examples that we will get into as well, how you can take advantage of ETFs opposed to individual stocks. But that's just an example I want to provide for you there. But to round it out, leverage. You can buy larger positions with a smaller investment. And you can really see that when we dive into the contracts. But I wanted to explain those indexes, those ETFs, and how you can kind of play around with the ETFs to get exposure to the companies that you want to invest in. Okay. Second reason why you choose options, portfolio protection. So again, you can hedge your investments and protect against potential losses with strategic options positioning. And we'll explain that a little bit further. And which is key, one of the main reasons why we buy options contracts, you generate profits from both rising and falling stock prices through smart speculation strategies, through fundamental investing. Okay? And this is the main reason we buy contracts. Because remember, a contract gives you the right but not the obligation to buy that underlying asset. At the end, prior to expiration, you can choose to buy that asset, or 9 times out of 10, the strategy that I use and I want to show you, all we're doing is creating income. We're not really at the end of it going to buy that underlying asset for a specific price. We're really just riding the share price higher, and we're going to profit from the difference between where we sell that contract or that coupon from where we bought it. Okay? And that is our goal, to sell it higher than where we bought it before that coupon expires. Oh, that coupon example, I know it's hidden for you now. Okay, let's move on. So options fundamentals. Now we're going to get into the details and nitty gritty of options contracts. So options contracts, one contract equals 100 shares of the underlying asset. And remember, in the last slide, we were talking about leverage power. This right here is the leverage power. One contract equals 100 shares. Okay? So let's show you an example here. So Amazon, okay? I want you to focus on this right here. So Amazon is ticker symbol, or its abbreviation is AMZN. These are called ticker symbols. They're kind of the nicknames of the companies. And this is how you can search for companies. Now I'm on the Robinhood platform, and I just have an option pulled up. This is the chart that tracks the price of the option just for today. This is the strike price, and we'll talk about that in a minute. This is a call option, and this is the price of our contract. Okay? Now remember, we just said one contract equals 100 shares of an underlying asset. Okay? So let's go back. So for one share of Amazon in this contract, it costs $10. Okay? We're going to times that by 100, right? Just some real basic math. So 10.48 times 100 equals 1,048. So for $1,048, hear me out on this. For $1,048, you have the power to control 100 shares of Amazon. Okay? Now this is what's really going to blow your mind. Okay? Amazon is trading at $220.29 per share. If you were to purchase 100 shares of Amazon, it would cost you, we're just going to do 220 times 100, $22,000 to purchase 100 shares outright of Amazon. Okay? So with the option contract, we're paying $1,048 to control 100 shares of Amazon, opposed to buying 100 shares of Amazon at $220, where its current share price is, and holding that asset and riding it up until eventually we decide to sell. So I hope that right there shows you the power of leverage in options contracts. You can control 100 shares of a company for a fraction of the price. And that right there is the power of options contracts and leverage. Okay, moving on. Call options. So call options give you the right to buy at the strike price or purchase calls when expecting rising prices. Okay? And the strike price is a fixed price where you can buy or sell the underlying asset regardless of the market price. And so we're going to take it back to this example. Now remember, I said AMZN is Amazon. It's the nickname, the ticker symbol of Amazon. This is a call for $235, and that is the strike price. $235 is the strike price. Okay? And remember, we had said our coupons expire. So for this contract specifically, this coupon expires by January 16th of 2026. So for this contract, if you were to buy it right now, which you can't buy it right now because the market is closed, but if the market was open and we purchased this contract for $10.48 with a total of $1,048, we have the right, but not the obligation, to buy 100 shares of Amazon at $235, right? Regardless of what the share price is on January 16th, 2026. Okay? Let me repeat that. Let's go back to the other slide. So call options, the right to buy at the strike price. Okay? And remember, in our Amazon example, our strike price was $235. And you purchase these calls when you're expecting the price of Amazon, the share price, to rise. Okay? And again, our strike price is a fixed price where you can buy or sell the underlying asset regardless of the market price. So if we purchase this contract, and there's different contracts you can purchase at different strike prices, but say we believe by January 16th, 2026, that Amazon share price, which is currently trading at $220, we believe Amazon will be trading at $250 plus. Okay? Say that's what we believe. After we did our fundamental investing, and we broke down the company, and we understood how it was trading historically, and we took that information and that data and looked how it's performing currently this year, because this year's almost over with, right? We're going into October next week. And then we can get an idea of how the company might perform in the future. And with that information, we believe Amazon will be trading well above $235 by that expiration date before the coupon expires. So we purchase a call, and if Amazon shares go higher and the contract looks appealing to buyers, that contract price will rise, right? It'll be higher than $10.48. Okay? And then if we chose, the contract would rise, and then before expiration, we could choose a few options. We could do nothing at all, and we will lose our premium, or the funds that we use to purchase this contract, the $10.48, we would just lose it. It would just expire worthless. Okay? Or if the share price was higher, say it was $250 plus, before expiration, we could purchase 100 shares of Amazon at $235 times 100, so $23,500. We could purchase those shares at $235, those 100 shares, even though Amazon will be $250 share price plus. So you see why that would be advantageous, right? We get to purchase an asset at a lower price than where it's currently at. Or the reason why we invest in options is the income generation. And if that option contract price has risen, we can sell it at a higher price. Okay? So I hope we explain that and double explain that, and so you understand it. Okay? And then put options. Now, in our strategy, we don't really do too many puts. Guys, honestly, the market is rigged to go up. So what we like to do is, if the market is pulling back, we just let our current contracts ride, and we wait for the dip and to buy the dip. and then we'll ride it back up. But you can hedge if you like to. If you're holding a lot of shares of a company, like well over 100 shares of a company, you can do puts. Or if you just want to make a play on a company that you think the share price might be falling, you can put in a put as well. But puts are the right to sell at strike price, and you buy puts when anticipating falling prices. So opposite of calls, you're going to purchase a call. You're going to purchase a call option when you believe the strike price will rise, and then the share price will rise, and you'll purchase a put option when you believe the share price may be falling. Okay. I know that was heavy, but let's move forward. Okay. Options chains, and I'll show you options chains on Robinhood right now. So we'll say we searched Apple up top here. All right. First is going to come up with information for the share price. But on Robinhood, you'll come over here where it says trade options. And this right here is called an option chain. This is where you go shopping. This is where you go looking for your strike prices, and you go looking for what you want to pay for those contracts for those strike prices. Okay? So think of an option chain like online shopping, a real-time catalog displaying all available calls and puts organized by expiration date and strike price. Okay? So there's going to be two sides of the coin. You're going to be in the money or you're going to be out the money. So let's go back to Robinhood. So you see this line right here. We're looking at Apple right now. This is going to be our option chain for Apple. And you see this red line right here. This says this is where the share price is, 255.49. That indicates where the share price is right now. Okay? Whoa. Robinhood's freaking out. Let's reload that. Okay. So we're going to go down to our share price. So anything above that line, right? That is out the money. That means the strike price you're looking at is above the current share price for the underlying asset. So in this case, Apple. That means you're going out the money. Out the money means it's riskier. That means you believe you're betting or you're investing and saying that you believe the share price of Apple will be higher. So you're going to go in the future or before the contract expires. So you're going to go higher than where the current share price is now and go out the money. Typically, we don't go higher than 2 slots above unless I have a lot of conviction and maybe the asset is trading significantly lower than where the company is valued at. Okay. Sometimes that happens. Like earlier this year in April, everything was getting wiped out, right? Liberation Day killed the stock market. April lows. My birthday is April 21st. I believe the market hit the low on my birthday. It was a rough April, but we got through it. So anything above that line, above your share price, that is out the money. Now, when you're placing out the money bets, your option contracts are typically going to move a lot more aggressively. Now, anything below that share price is in the money. That means you are in the money. Your contract should be profitable. Okay? So those contracts are going to cost a little bit more. They're a little bit less. They're less riskier, right? You're already in the money. You already have some cushion underneath you. Whereas if you're doing out the money, it's a little bit riskier bet because the share price is below where that currently is. The asset has to do a little bit of work to get higher in order for your contract to be in the money, to be profitable. Okay? So that's pretty self-explanatory, right? Now, the Greeks. Now, the Greeks are something that I pay attention to, but we're not going to go over every single one of them. I'm just going to give you the the candy that you need today. And then if you want to join the Patreon, the paid version, the Patreon in the future, then we'll dive into it. We'll really get nasty in that Patreon, if you feel me. Okay? So the Greeks, so we're going a little bit further. So remember, the ticker symbol or the asset, the strike price, it's a call. And this is the cost of our option contract or the premium. Remember? The price you pay for the coupon, that's the premium. Now we go down, we got a little bit of information down here. Let me blow it up so you guys can see it. So for this contract, I am holding two contracts here. You can see the value of that contract that you're holding. It tells you your total return, and this one I'm actually down. Gives you your average cost. It kind of gives you an estimate what your break-even cost is. Amazon has to be an X share price for your contract to break even. It tells you the time that the date that you bought the contract. And then down here we have stats, okay? Open interest and volume. Before we get into the Greeks, I want to talk about open interest and volume. Open interest is everyone that is invested in this contract and has not exercised the right, have not done anything with that contract. So that is, if I had to put it simply, it gauges the interest in that contract of people who are still in it, still believe in that contract. And one thing I want you to kind of be aware of is to follow the money. You'll see contracts where open interest is very small. It'll be not even 1,000, it'll be in the hundreds. And you'll see open interest will be in the hundreds of thousands, right? For us, and I want you to write this down amongst other things that we've been telling you, we want our open interest to be 10,000 plus, right? Those are for the contracts that we are really excited about. There's a lot of conviction around those. Now, we will find some that'll be 5,000, 6,000. And we'll still jump in those. But the ones that we have a whole lot of conviction for are the ones that have a ton of open interest. Now, volume is based on the day, and it kind of tells you how many folks are in and out of this contract in a given day. Okay? So very important. We like to see volume because that provides liquidity. That means people are transacting in this contract. That means if we wanted to sell it, we'd have some people that would probably be interested and we can get off of that contract. And then open interest, we just want, that's kind of just like follow the money. If there's a ton of open interest, that typically means a lot of people believe this is a great bet. Okay? So open interest plus 10,000 is typically what we're looking for. In volume, we would like to see volume in the thousands, but this 500 here, I'm all right with that here. I'm comfortable with that here. Okay, now let's get to the Greeks. Now let's go back to our page and let's read a little bit. And so we're going to talk about the delta and the theta. Now the delta is the one that I typically look at the most. That shows a probability your option expires in the money. Remember, in the money is above, the strike price is above. I almost told you guys wrong. In the money is the strike price is below the share price. Okay? You are in the money. You are profitable. You are green. Okay? And for example, if you see a 0.5 delta, that is a 50% chance of success that your contract will expire in the money. So we'll go back to this contract that we were looking at, and we'll see a delta here of 0.41. And so there's only a 41% chance that this contract will expire in the money by this expiration date. I ain't scared. I'm a believer in Amazon, and yes, it's below 50%. It's a little dicey, but we have a couple months to have Amazon turn around, which I believe it will. Amazon is just a little bit of a slump right now. Okay, so does everybody understand that? I hope. All right, we're going to move on to the theta. Now, the theta measures time decay. Remember, Our expiration date is like as soon as we buy that contract, we pay the premium, we purchase the contract. We want to be in the money. We want our strike price to be below Amazon's share price for us to be in the money, because that typically means the option contract will be higher than when we originally bought it. We want to ensure that we are selling this contract before the expiration date, because time is working against us. Each passing day, time is working against us. And that's why in our strategy, now you're going to see a lot of people that are just do 0-day options. That means they are getting in and out of an option contract in one day. Some folks do very short-term trading. They're extended for a couple minutes to get in and out. Okay, and those guys are technical analysis. They're watching charts. For the beginners, charts are nice and they can help. But I want you guys, because I just recently started getting into the charts and helping me. So that's a little bit more advanced. But with the fundamental playbook, if you take those fundamental concepts and you apply that to your strategy, that should be able to help you. And then the charts on top of it will really change your game and have you a little bit working more precisely, entering and exiting your trades a lot faster. So there are a lot of folks that are in and out very quickly, and those are very risky plays. Our strategy, we typically like to hold our contracts at least minimum 3 months, but most of our contracts are going to be 6 months plus. Ideally, you would like to get your contracts a year out because you pay less in taxes, but your premium is going to be a lot more expensive when you're buying time. When we're buying contracts, we're really purchasing time. Okay, so that's why you'll see a lot of my contract. This contract, I don't have a contract shorter than this January 16th, 2026 date. And to be quite honest with you, I'm a little uncomfortable because we don't have a lot of time on those contracts. Remember, like I said, this one's down. But I'm confident in Amazon. There's a couple other ones that we have. If you're interested, we'll look at them. There's another one that I have that expires in January, and it's this DraftKings, and I know it's probably not 0.41%. Yeah, 0.28% chance of expiring in the money. Now, again, DraftKings is one of those plays I have a lot of conviction for. I believe it's just a matter of time this one turns around. I've just been waiting super patiently for this one to turn around. So again, theta measures time decay. Remember, we're paying for time for our contracts. That's why we usually buy a little bit more expensive contracts further out in date, which the premium is higher. And we are selling those contracts 30 to 45 days before expiration to avoid rapid decay. The closer you are to the expiration date, time works against you, and your options will start. Your premiums, your options contract costs will start going down a lot faster. Right now, when the market fluctuates, your share price moves 1% or so. Those option contracts are going to move pretty aggressively. But when you are close to the expiration, like a month out, if your option contract moves 1%, your option price is going to significantly drop. So what we like to do, we like to buy time, but we like to get out of those option contracts. We like to be out 30 to 45 days before expiration. Okay, so typically a month or a month and a half before expiration. Okay. All right. Winning strategies, that when to enter and when to exit. So we talked about this last slide. Choose longer time frames. Select contracts expiring 6 months plus out. Time works in your favor with longer duration contracts. And just to kind of show you guys that I'm practicing what I'm preaching here. You see the January contracts, and then let me blow it up for you. See Amazon, we show you that one expires in June 2026. And then 115.27, 115.27. These all expire well over a year from now. So yes, those contracts cost a little bit more. I believe this NVIDIA one costs about $4,000 in total for the contract, because I got my strike price is super aggressive. NVIDIA is trading around 178 or so, and the strike price is at $200. So I have a lot of conviction for NVIDIA, and I'm holding that one long term. Okay, longer time frames. Have time work for you, not against you. Have it in your favor. Now, set clear price targets. Determine specific share prices for both entry and exit before placing any trades. So before you even get into buying your contract, you want to know exactly when you're going to enter the trade and where your exit's going to be. What is your target exit price? Okay. Again, you can map that out with the fundamental investing playbook. When you open up the company, and we'll give you the tools, and you can kind of determine, all right, I need to get in at this price, X price, and then when it hits X price, that's when I need to sell. Okay. Take profits strategically. When contracts hit 100% gains, withdraw initial investment and let the profits rise. And so what do I mean by that? Well, most recently, it didn't quite hit 100% for us, but we had multiple contracts of this Palo Alto contract. As you can see here, our total return is currently at 89%. But this was at 100%, and we had multiple contracts. Once it hit 100%, we sold those contracts, and we took out our initial investment. So once your contract hits 100%, as long as you didn't average down or anything like that, that means you have recouped your initial investment. You can take out your initial investment and then just let the profits rise with the remaining contracts. And that's the play that we like to use. It's kind of a rinse and repeat. We bought in, the contract moved up. We had multiple contracts. Now, not all the times we're going to have multiple contracts. So sometimes when we reach 100%, we just take our money out, we doubled our money, and we find another play. Sometimes, depending on our target price, we let that contract continue to go higher, and we do something, we set stop limit orders and don't allow our contracts to fall further than a certain threshold. Okay? And we'll talk about that in the future as well. So this is just kind of our strategy. It's a rinse and repeat. Once you hit a certain target, if you have multiple contracts, take out your initial investment, let the profits rise. Then watch and monitor that. You have one contract, it hits 100%, depending on your target price. Maybe your target was at 100%. You got out and you're moving on to another investment. Or you hit your 100%, you let it ride, and you set a stop, and you don't let your contract fall below that 100%. If it does, it triggers a sale. You get your money. Okay? And find your next play. Use recovered capital to identify new opportunities while profits continue working. Like we said, you take out that initial investment, you let your profits rise and continue to make money for you. Now you have your initial investment back to jump into something else. Doesn't have to be the same contract. You can wait and get into the same thing, or maybe you find something else. I'm a fan of diversification and find something else. All right. Now this is coming from my experience. I had to learn the hard way, but great information to have regardless. So buy the dips. You want to purchase your contracts when the markets are red. Yes, that sounds so opposite of what you should be doing. Most people like to chase when something is taking off. That is not, the last thing you want to do is buy high. You buy low and sell high. Okay? That is our strategy. Buy low and sell high. You have a lot more room when something has fallen. It's a great company, but for whatever reason is at a distressed price. Okay? Warren Buffett, I've talked about him earlier. Warren Buffett, one of his best things that he said, one of his quotes is, buy great companies at discounted prices. Buy great companies at discounted prices. Not decent companies, not fair companies. Buy great companies at discounted prices. So, example of that, when the market was bloody, and we're going to look at the S&P 500 because that kind of shows you the overall market. When the market was bloody in April, market was down, S&P 500 was down 15% year to date. I was buying assets. Now, the bad thing is that I was buying and I was catching a falling knife. So that's the good thing about looking at the charts and having technical analysis, because you don't want to get caught trying to buy something at the bottom and it keeps falling. That's called catching a falling knife. But we bought great companies during that time. We sold some assets, which did in turn run off, and we got into eventually. But because of that sell-off, we were able to get expensive companies like Meta. We got into Amazon. We got into Netflix. We got into Palo Alto. When Palantir dipped, we got into Palantir. And so we bought these great companies that were doing extremely well before Liberation Day. And we knew eventually the stock market, like we said, it's rigged to go up. Eventually we would get through this tariff situation and things will normalize, stabilize, and hopefully a bull market would take off again. And that's exactly what happened. And by doing that, my retirement account has done significantly well. Some of the smaller accounts that I have are doing extremely well. And I will show you my options portfolio. Now, you should be having 20% of whatever your overall balance is in cash, but I just took some money out for a different investment outside of the stock market that I'm excited about. I'm not going to be able to really take advantage of it for a couple of years, but I was happy to be able to invest. But just year to date. So we started off this year, and mind you, these numbers aren't necessarily accurate because I've taken money out. But for this example, it's fine where it is. So say we started this year at 11,000 our account. I want you to look at this. And this is about investing. It's having conviction, sticking to your game plan, and having conviction despite it seems like the world is ending and nothing is going right. So we started around 11,000, had a little bit of a dip, and then we shot up to 22,000. Okay? Doubled by February. Nice start of the year. Now watch this. Trump gets into office, starts talking about tariffs, Liberation Day. Look at this. The count actually reads negative $10,000. But despite everything on the news, all the contracts that I had them, the expirations were further out. I did not panic. I did not sell. Look where we are now. That massive run, down negative 10 to up 39. That's the power of options and the power of holding on long term. We had time on our side. We weren't doing short-term investing. So I know if I can do this, you sure as heck can do it too. But I do stress that fundamental investing playbook. Without opening up that companies that I was invested in its options, while opening up fundamentally and understand the numbers and the data, understand exactly how that company generates income, profits, who its management is, trusting that management, looking at the data and seeing, yes, they are very effective. And knowing these best companies in the world like Amazon, Apple, Meta, Palantir, all of them, they have strong balance sheets and they can stomach those ups and downs in the market. Opposed to some companies that aren't great companies, they may not have the balance sheet. They may not be as strong as fundamentally strong companies. In those tariff situations, those swings in markets can really cripple a company, and it's hard for them to recover. But those best companies, the Magnificent Seven, those companies that I was invested in at the time, I knew they could weather the fight. They had a great management team and had a great balance sheet and great business practices to weather the storm. So that's why I stress fundamental investing. Fundamental investing. You can play with the charts all you want, but fundamental investing gives you more conviction, more confidence, understanding what you're invested in, to stay in it the long haul, even through the ups and downs. Okay? So I just wanted to share that with you guys. All right, buy in the dips and resist chasing runners and be patient for opportunities. Again, buy red. When the market is red, you should honestly be getting excited. Oh yeah, I'm about to get in some new assets. You got some cash on the side, ready to take advantage. Okay? Now moving on, the ETF strategy, and we touched on this earlier. Trade QQQ for tech exposure with lower risk than individual stocks. Those meta calls are super expensive opposed to a little bit cheaper as those QQQ calls. And those QQQ calls, the ETFs don't fluctuate nearly as much as an individual stock will. So those ETFs provide you a little bit of defense and lower risk opposed to investing in individual stocks. And then risk management, we touched on this. I remember I just took some money out, so I was practicing this. But keep 20% cash available and limit single trades to 20% of your account. And so what I mean by that is, whoops, wrong button. I should have $8,000 in my account. Remember, I just took out some money, so don't fight me, okay? Don't show you, but I just took out some money for another investment. But I should have $8,000, approximately 20% of whatever my overall balance is in cash to take advantage. And none of these individual plays should be more than $8,000 because I don't want to have too much in one individual play. That's just managing risk, and we're being smart about it. You don't want to blow your account. That's the last thing you want to do is blow your account. It tears your confidence apart, and you have to build it all the way back up. I don't want anybody to suffer from that. I haven't blown an account. I don't expect you to blow an account. And start small. Begin with one contract and master consistency before scaling up your position sizes. Start small, get a little bit more confidence, and you can get those multiple contracts in where we're saying once it reaches 100%, you take out your initial investment and then let the other one ride and get busy for you. Okay? All right, and we are closing out. Are you ready to start trading now? So I highly suggest, now for my long-term investing, I use Merrill Edge. I could trade options on there, but it's a pain in the butt. So I highly suggest using Robinhood for beginners. It's extremely easy interface and easy to navigate. You're going to open an individual account and a self-directed account. Let me see if I could walk you guys through that. There we go. I'm not sure if I can do it on this one. Okay, but regardless, you're going to open up your Robinhood account, right? And then you're going to start an individual account and a self-directing account. It's pretty simple. You can do it in minutes. Then, within settings, I need you to go to investing, and I need you to apply for level 2 options trading. If I can find where it is, guys. I thought it was in here. I'm sorry, guys. I can't. There we go. So you go under settings, investing, and then down here you should be able to apply for level 2 options trading. Again, it shouldn't take too long. Once you have that approved, then you can fund your account. Then you're going to join the Patreon. You can join for free. And I put in a post every single day, a video every single day. It's called The Grind. You can follow me on YouTube. You can watch it now for free. And then I also post options trades, which are real-time options trades, exactly when I enter a trade, exactly when I exit a trade, in the Patreon in the paid version. So you get exactly when I enter and exit a trade in the Patreon for $10 a month. Plus you get the fundamental investing playbook that is essentially just like this. We go over slides. You can watch it over and over again. Pick up with some of the things that might have lost or forgot about or didn't quite understand. And you can also join that Patreon. You can ask me questions. Maybe I didn't do a great job of understand or explaining something to you. Jump in the Patreon. This is whether it's a free version or not. Ask me questions. Ask away. Okay. I want to go over some tools that I need you guys to start utilizing. Number one is the Yahoo Finance app. Okay. You can create lists on here. You can create alerts for some of your companies up here. And once your target prices are hit, it'll send you a notification, and then you can execute. You can buy long-term shares, or you can buy option contracts once the underlying asset you're tracking hits your target price. Okay. And if you want to learn how to build out those lists, again, the Fundamental Investing Playbook is available, and the Patreon is only $10 per month. Okay. Mind you, some of the plays that we made just this month have profited us well over $3,000 in just a month. So just be mindful that $10 we can make 100x that in within a year's time for sure. $10 a month, it is definitely a deal. But this Yahoo Finance app, I'm on this every single day. I track all of my options. They're in here, all my long-term investing companies, and you will see vast majority of the company I hold long-term in my retirements accounts or other smaller accounts. I am doing options in those same companies. I understand these companies. I see how they move on a daily basis. These are the same companies that I'm doing options on. Super simple. You don't have to go search for all these other different companies that you want to invest in. Rinse and repeat the same companies over and over and over, especially if they are great companies in generating massive profits and revenue. Okay, let's move on to bar chart. Bar chart, this one right here is a game changer. So let's go to Apple. So I'm going to put in the ticker symbol at bar chart right up here in the search bar, and Apple's going to come up. Then on the bottom left side, what I'm looking for is under analyst ratings. Okay. Now right here is your cheat sheet. If you didn't have the fundamental playbook, you could look at this. This has how many analysts? 38 analysts that are probably much smarter than us and have been following this company probably much longer than we have and have more data information on the company than we could probably find ourselves. These analysts give you target prices. Okay. It gives you the share price of Apple. It gives you a 52-week high, the 52-week low. Then it gives you the low target price for some of the analysts here. It gives you the high target price for some of the analysts. And then it gives you the mean target price here. You can use these if you like as your target prices. Okay? And then here they rate. It could be strong buy, moderate buy, strong sell, whatever the case may be. This will kind of give you the conviction of how, you know, hard you want to go into this investment. So bar chart, definitely something for you to take advantage of. Moving along, the RSI, the Relative Strength Index. Okay? So to make this kind of simple, this will explain to you if a company is overbought or oversold. Okay? Anything 30 or close to 30, that is extremely oversold. Anything close to 70, which Apple is right now, it's at 70, is overbought. We like to buy when the RSI, and I know it's pretty small, but you can see it right here. You just type in ticker symbol Apple and click update. And you'll see right here 69.69. Okay? We like to jump in and ride our options right when they're at 50 and heading towards that 55, and then kind of take off. And you can kind of see it here once you play around with it. You see where that 50 mark is, and you get take off. Some of them take off. And so that's what we're looking for. We're looking for RSI around 50 to 55 range, and that'll be our time when we're like, all right, it's time to get in. Okay? Next, this is the heat map. Now, I stole this one from one of my favorite traders to watch on YouTube. And here, you can go and buy different indexes. So now I'm looking at the S&P 500. And these are all of the companies in the S&P 500. And you can see how they're performing by the year to date, how they're performing for the week, how they're performing for the day, how they're performing for 3 months, 3 years, 5 years, 10 years. And you get a lot of information here. I like to come here and look at ideas of companies to invest in. Maybe it's a point in time when the market is down, but typically when the market is down, there's usually some type of rally going on somewhere in the market. And so I like to come here and maybe look and see what sectors are really performing well at a specific time. So if we look for the past month, really we have green all over the place, which is good. We're kind of broadening out. But the really green ones are the means that they are up the most. The darker greens means they're up, just not as much. And then the red obviously means down. The bloodier the red, that means they're down the most. So this is a great way to just get an idea how the assets are performing and get some ideas of what you might want to invest in. Okay, and I'll put all of these links in the YouTube description as well. And last but not least, Fear and Greed Index. So this just tells you the market sentiment. All right, neutral is kind of self-explanatory, which is kind of like even kill. Greed, we're all right if we're in the greed. That's perfectly fine. But now when we skew towards extreme greed, that's when I start to get a little bit uncomfortable. When everyone's talking about the stock market, and it seems like regardless of wherever you put your money, the market everything's just going up. Everyone's making money. All companies are making money. That's when we get a little bit of dangerous territory, and we might want to consider de-risking a little bit, taking a little bit off and sitting on some cash. Whereas if we're in the fear and extreme fear, I might be waiting patiently and being decisive and waiting for a moment where it looks like the momentum is shifting and we're taking the shares higher. And that's when we want to go in heavy when the market is bloody, right? Remember, buy low, sell high. We want to buy when the market is red. We want to buy at discounted prices rather than buying at the top. It's very difficult to buy when you're buying at the top. Okay? And then as well, If you are an iPhone user, Apple News Plus, it definitely worth the purchase. Getting all that information, the research, Wall Street Journal, Barron's, CNBC, and then also my retirement accounts. I manage them in Merrill Edge, and Bank of America has excellent research. I use their research, and they are typically pretty spot on. So I highly suggest you guys getting into that as well. So that is it. Hopefully, I debunked the myth that options trading is difficult. Just think of it as a coupon. You're purchasing a right to use that coupon before it expires, right? Now we can purchase that coupon, and it gives us the right to purchase that asset at a preferred price at a later date. Or we can just purchase that contract, let the premium, the cost of that contract rise, and then we can sell that contract later and generate passive income. So let me know in the comments, share, definitely share if this is beneficial to you. And I hope to see you in the Patreon, in the paid version or the free version. Peace.